All right, how you doing today? Welcome to Fail Safe Wealth. If this is your first time to my channel, if you already been on my channel, you know what I do on this channel. I analyze companies, analyze stocks. I'll walk you through my whole entire process on like what I look at when I'm looking into a stock, all the metrics that I look at, how I evaluate these metrics, and pretty much give my opinion on if this stock is overvalued, fairly valued, or undervalued based on all of these things, pretty much a fundamental analysis and not just my thoughts in my opinion on a company. So welcome to another edition of Battle of the Brands. Let's go. Let's go. Okay, so today is a very special episode. I've been getting a lot of people asking me about pretty much stocks that has something to do with babies. Let's just say that. So like people are telling me like stocks that involve like diapers and baby products are pretty much good buys right now because a lot of people are forced to stay at home. So those people that are staying at home with their significant other are of course doing some things and pretty much that will lead to the production of another child. And I'm always welcome to another human being walking on this earth because another human being means more capital to be pretty much in circulation in the world. Let's just look at it like that. So now, this is my take on these type of companies. First off, there aren't a lot of options in the stock market that revolve around pretty much babies or pretty much child products. They're like a very small handful of companies. Johnson & Johnson is one of those companies. Procter & Gamble is one of those companies. And then there's like another company. I can't think of it right now on top of my head. I'll probably throw it in the video. But anyway, you pretty much only can get your hands on one of these companies because these companies has been around for a very long time. They've had time to, they pretty much encompass all of those brands. So today's video is on Procter & Gamble. Now, Procter & Gamble was started, or should I say founded around 1837. So yes, that is correct. The company is 182 or 83 years old. It's very, very old company, been around for a very, very long time and has been on the stock exchange for a very, very long time. They have been through multiple recessions, depressions, all of that stuff. So Procter & Gamble is a really good company to put your money into. And I'm gonna give you my opinion on this company and pretty much tell you what I think about it. And then realize if this is a value company, growth company, or just somewhere to park your money. So let's get right into it. Procter & Gamble, ticker symbol PG, selling for around like $135, $138 a share. Currently, this isn't a really volatile stock, so I don't see it dropping too much below 135 or rising above 140 in the near future, but anything is possible. But we'll just say today, $138 per share, has a market cap of $342 billion. Yes, this is a mega cap company. They are included in the Dow Jones Industrial Index, which is like the top 3 industrial companies in the entire stock market. And they pay a dividend yield of about 2.29%, have a price to earnings ratio of about 27, and has an earnings per share of about $4.96, with a payout ratio of 64% of their profits. Now, those are pretty solid numbers for any company. Any company around those are great numbers. If this was a growth company, the stock price would be about probably $700-800 right now. Since the company's market cap is so large, there probably isn't that much growth in the future of this company. Extreme growth, let me say that. Now, they'll have the average growth, like the stock market averages around like 7% year over year. So they'll have that percent of growth in the stock price, but maybe not in the market cap. Now, if you don't know about Procter & Gamble's brands, they pretty much cover everything. They are everything that has to do with consumer staples. They are in the consumer staples sector in the stock market. Now, if you don't know what consumer staples are, they have consumer staples and then you have consumer discretionary spending. pretty much to make it simple, if you have money left over from buying all the things that you need in your daily life, then that will land in the consumer discretionary spending, meaning money that you have that you can spend at your discretion. Hence the word. And your consumer staples is kind of how it sounds. These are companies that has a product that at some point in your life you will need to buy. It is really that simple. Like, it's that simple. So Procter & Gamble have everything from Luvs diapers. They have the brand Pampers. They have pretty much all the laundry detergents like Gain, Tide. They have Old Spice in their portfolio. They have Gillette in their portfolio. Tampax, Clear Blue if you're expecting a pregnancy. They pretty much cover everything in the daily life. They have a lot of brands. It's crazy, believe me. Even some of the brands they own that I was even shocked to see. So they have a lot of brands. This is a big company. This company has been around for over 100 years, close to 200 years. So I don't see this company going anywhere anytime soon. But like I always say, that's not the full picture. So before we get into the financial statements and all that, let's just look at the basic metrics like the PE ratio and the earnings per share, the dividend yield, and the payout ratio. So like I mentioned, this company has a $342 billion market cap. That is a mega cap. So the company is not volatile. This company probably won't be going out of business anytime soon. They can always issue more debt since they have assets to leverage those debts too, pretty much by issuing bonds and leveraging products and things like that. Licensing fees, I can go deep into this, but we're not going to go down that rabbit hole today. So this company is huge. It probably won't fail anytime soon, but it probably won't be growing like crazy anytime soon. I don't see this company going from $342 billion to $600 billion in the near future. It's going to take some time. It's going to have slow growth. Even if you look at the chart of this company over its entire lifespan, it's at an all-time high at $138, but it took a long time to get there. Like, this company has slow growth. And if you look even at the revenue, which I'll get to in a second, the revenue isn't even growing by drastic numbers. The revenue is growing like 2% year over year. And like I mentioned, they're pretty much growing at an average rate. Now, the stock market gives a return about 7% year over year, but the dollar has an inflation rate of 2% year over year. So it's pretty much growing at the normal inflation rate. So the PE ratio being at 27 with a slow growth company that is already a mega cap, this company, I don't know what to say. I don't think that it's worth getting into unless you want a stock to pretty much park your money in. But that just makes the case for this company not failing anytime soon. Like I said, you could probably park your money in there, but that doesn't tell you if this company can grow, pretty much have principal appreciation, which means the stock price grow, and then the dividend payout is more since you have more money invested in the company, or how it would look. But like I said, this is somewhere, in my opinion, to like just park your money. I would call this like a value play. This would be considered a value company. Value companies really don't fail. They are blue chip companies, but these aren't the companies that are going to make you wealthy unless you are already starting out with a lot of money. This is a low risk company. So with low risk comes low reward. Now, if you don't believe me, I'm just going to pretty much give you the financial statements for you to paint your own picture, and I want to know your opinion. So let's get right on into it. Let's look at the financial statements. Okay, so Procter & Gamble is one of those companies that is a quarter ahead. So Procter & Gamble's first quarter or 2020 fiscal year ended in July. So it ended July 30th. So you can actually go and look at their 10K for 2020 now, and they are already in the year 2021 as far as their fiscal year go. So that actually works out in their favor, because if you really looked at their 2019, it was ugh. So in 2020, Procter & Gamble posted a revenue of around $70 billion, which is pretty good, especially from 2019, where they posted a revenue of $67 billion. But we're going to look at the current assets on the balance sheet versus the current liabilities, and then the total assets versus the total liabilities, and see how much working capital they have to work with. So going from a $70 billion revenue, we have $16 billion in cash on hand and about $27 billion in current assets. Now that is really good, especially for a company this size, been around this long, right? But when you look at their current liabilities, they have current liabilities at $32 billion. So they do not have enough cash on hand or enough cash coming in this year, or it's pretty much safe to say that they cannot liquidate enough cash to pay off all of the debt for the year 2020, and yet they're still paying a dividend. They are paying a dividend, which is kind of crazy. Now, I did make a video earlier where I said that there is no obligation that a company has to pay a dividend. That is always at the discretion of the board members. Now, if I was running this company, I would cut the dividend to make sure that I have enough cash on hand to pay off all of my current debt and liabilities and have room to grow the company. Now, I haven't looked too deeply into this company, but any company that has more current liabilities than current assets on the balance sheet is already looking bad in my eyes. Now, the current assets does not also include property, plant, and equipment, which are assets that can be sold off. So when we take that into account and we look at the total assets versus the total liability, we're looking at 120 billion in total assets versus 73 billion in total liability. So yes, in that sense, it is good, meaning if they make it through this year, that they will have enough money to pretty much keep continuing down the path that they're on. But in the sector they're in, this isn't shocking to me. Like, a lot of companies in the consumer staples sector kind of operate on this. We have products that people need, so we're always going to be in business. We can operate with debt, which, if you kind of think about it, it makes sense. It's kind of like a person that's living paycheck to paycheck and maxing out their credit cards. As long as they got a paycheck, a job coming in, they can just pay off the minimum and keep going. So I get it, but I don't like it. As an investor, I would personally try to stay away from a company that's structured like that or even looks like that. Even if it is in the consumer staples field, I would just try to stay away from it. But we have to continue on to the income statement. So like I mentioned, $70 billion in revenue, and they have $12 billion in net proceeds, meaning $12 billion in profits. Now that is good. And then when you look at their capital expenditures, meaning the money that they are spending to grow the business, probably marketing and all of that stuff, that's sitting at around $3 billion. So when you subtract that $3 billion from that $12 billion, you're left with $9 billion in actual true profits, which people like to say free cash flow. It's free cash. You can do whatever you want with that $9 billion. Now this company, in my opinion, I'm going to say that it is overvalued and significantly overvalued. Even though they have a dividend, it's set up solid, but the return that you're gonna get on your investment is minimum. Like, you're gonna get average, a little below average. Now, if you compare Procter & Gamble to the Dow Jones Index, it has beat the Dow Jones Index over a long term. But I'm just saying, if you're looking for a bang for your buck, there are a lot of better suited companies out there. Even if there is a boom in births in the year 2021, that will be a blip on the radar, and it won't translate into the stock until probably a year after that, and when they start reporting those earnings and all of those things. And even then, it won't make a significant difference in the stock price or the revenue, unless it's like a billion babies born or something like that. Because yeah, they made $70 billion in revenue, but they spent $31 billion to get that $70 billion. So you always have to take that into account, the cost of sales. Now, like I said earlier in this video, this company probably has bad management because they spent about $8 billion on special items. They spent about $8 billion on special items in 2019. And it was about another billion before that and the year before that. So what are they spending this money on? Like, special items could be anything on an income statement or balance sheet. It's like we spent $8 billion on a jet, but we don't want to say a jet, or we spent $1 billion to throw a party on a private island or something, but we don't want to say that, so we just put special items. These are supposed to be non-recurring items on the balance sheet, but hey, this company, they got money. They've been around long enough. Now, I'm no specialist. I am just doing this for entertainment and trying to help people out, help people understand how to invest, how to analyze a company. If you have any questions, hit me up on my email, hit me up in the comment section below. I do respond to my comments. Now, if you haven't subscribed to my channel, hit the subscribe button. And if you have time, hit the like button, hit the share button. Everything helps. Now, I want to know your opinion about this video. I want to know your opinion about Procter & Gamble. If this is a company that you will be interested in, what was your thoughts about Procter & Gamble prior to watching this video? I just want to know. Talk to me. So until the next time, let's get it. Let's do it.